Hi everyone. Today's topic is the one of the most important topic of finance. That is the capital budgeting and decision criteria. In this chapter, you will learn the type and the special features of capital budgeting decisions, how to calculate, interpret, and evaluate the capital budgeting techniques. So the principle that apply to this chapter is number 1, TVOM, right? Number 2, risk and return trade-off. Number 3, cash flow are the source of the value. Number 4, individual response to the incentives. So this chapter will concern the first question in order to become successful the CFO. So what you need to do is you should know what kind of project. I mean, do you have to know should you invest in the project? Okay, so your job is to make investment decision, which is what? When you look at the balance sheet, right, you see the lower left hand side is fixed asset. So this chapter will concern how do you pick those fixed asset, right? So capital budgeting is investing in the long-term asset. So we have root definition like capital means the fixed asset used in production or any project, right? Budget is plan of in and outflow during the sum period. Capital budget, a list of planned investment, right, outlay for the different project. And the capital budgeting is a process of selecting viable investment project, right? So you need to understand the root definition of the capital budgeting. So we have so many type of project like expansion of the old product, right? Maybe expansion by coming up with the new product, right, on the market. Replacement project, to maintain the business, right? Maybe you want to save the cost, replace the old machine with the new one, so that you can increase efficiency, right? So your job is to make sure whether or not you want to buy the new machine, right, or you want to do the new project. Maybe this project is for safety, right, or environmental projects like the flood protection system and others, right? And also the project can be categorized to be independent and mutually exclusive. Independent project means what? Independent means a project that has nothing to do with other project, right? Like replace a copy machine has nothing to do with building a new plant, right? This is an independent project. What about mutually exclusive? Mutually exclusive means you must pick the better one, right? You only need one of these alternative projects. Let's say you want to buy a new computer. They have choice. You have choice, right? Whether or not it's IBM or Apple. So this one is called mutually exclusive project. So again, you need to memorize this one. Capital budgeting is the process of planning to invest or for purchase of long-term asset. For example, suppose you must decide whether or not you want to purchase the new condo or construct the new condo near ABAC for rent, right? And the cost is assumed to be $125,000. How do you decide? Of course, right? You need to ask yourself, will it be profitable? Profit means what? Revenue greater than cost, right? Revenue greater than cost. How do we calculate the revenue? You have to make the net present value of the expected, the cash flow that you're about to receive in the future, and then subtract with the cost that you're about to pay right now, which is $125,000, so that we get net present value. If you get profit, it means NPV or net present value will be more than 0. If you reject the project, means you get loss, right? Loss means what? The expenses, right, or the cost is higher than the revenue, all right? So NPV will be negative, so you will reject the project. So this chapter, the ultimate goal for this chapter is to make decision whether or not you want to accept or reject the project. NPV, the unit is currency, right? The profit or loss, the unit is currency. But if we want to know how many percent rate of return, if you do the project right now, and the project cost that you need to pay right now is $125,000, and you expect to receive the forecasted amount of cash flow in the future, how many percent rate of return do you expect? That is internal rate of return, or what we call IRR. IRR is the rate of return. We will accept the project if rate of return is greater than rate of cost, right? The cost of 125,000 or cost of providing the capital to use for the project at the beginning we call WACC, right? You might raise 125,000 by using equity, maybe preferred stock, maybe common stock. What should be the average cost of 125,000? Which that is what WACC. So your job is to compare IRR with WACC. If IRR is greater than WACC, which means return greater than cost, so we should accept the project, right? On the other hand, if IRR or the return is lower than cost, we should reject the project. Just like the stock, if you remember, before you make decision to buy the stock, you have to find the intrinsic value. Okay? Look at the picture. How come you get intrinsic value? You have to find the discount, summation of discount dividend, right? Expected dividend until forever. You see D1, D2, D3, D4 until D infinity. You got to discount those dividend back to time zero by using KCS or rate of return for the common stocks. Let's assume D can grow up at one constant rate G and K greater than G. So we can use Gordon growth model to find the intrinsic value, right? D1 divided by K minus G. That is similar to the revenue, right, that we talk about. The summation of discounted expected dividend. So we got to compare that revenue that we discounted already to what? To the cost that you pay for the stocks, which is, let's say you buy at market price, right? So if you about to buy this stock, you have to make sure that intrinsic value is greater than the market value, right? So that it makes NPV more than zero, and you accept this project of buying the stocks. Just like any project, right? You invest right now. Unlike the stock you buy at market price. You invest right now at the project initial outlay. How much you have to spend right now. And then what? You expect to receive the cash flow, right? Free cash flow from year 1 to until year end. Year end is at the end of the project life, right? So the cost to providing initial outlay is WACC. So what we need to do is to make summation of the discount, the cash flow, right? Discount by using WACC. That is revenue, right? So we need to take revenue and minus or subtract it with initial outlay, which is cost, right? So if NPV more than zero, you accept the project. If NPV lower than zero, again, reject the project. Right here is a formula for NPV. Summation of discounted free cash flow, right? Using the WACC is revenue, and you have to subtract with initial outlay, which is cost, right? And also, if you want to find how many percent return, you need to find internal rate of return or IRR, right? Let's assume if you invest right now, you pay IO and expect to receive free cash flow for n year. How many percent rate of return? That is IRR, right? So let's compare two equations, NPV IRR. What is that? As you can see, right? NPV is the bottom equation, right? IRR is above. If you compare, what do you see? If you let NPV equal to zero, right, and change WACC to be IRR, you get equation for IRR, right? So IRR is the point that NPV equal to zero. IRR is the point that NPV equal to zero. So you get this equation, right? Zero NPV equals to summation of free cash flow discount by IRR, right? And minus initial outlay. So this one is the equation for IRR, okay? Why do we need to learn capital budgeting? What is it good for? Since your job is to maximize wealth, wealth comes from long-term profit, right? Long-term profit come from what? Come from good project, right? If you pick the right or good project, you can generate long-term profit or wealth, right? That's why we need to pick the right investment or the right project in order to maximize the wealth. Right, so here the step, right, to in capital budgeting. Number one, you have to estimate all related cash flow, both inflow and outflow, right? And excess risk of the cash flow, right? And third one, find the discount rate for the project. And the last one, use the tools, right, to evaluate the project, just like NPV or IRR, to make investment decision whether or not you want to accept or reject. Okay.